Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here's a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Imagine buying a massive plot of empty land. And before you even pour a single yard of concrete, the biggest technology companies on the planet just walk right up to you.
Right, they just show up.
Exactly. And they hand you $27 billion in guaranteed rent. I mean, you haven't even built the physical structure yet, and you are already completely sold out for years.
It's wild. But that is the sheer scale of the situation we're unpacking today with Nebius Group.
Yeah, we really have to put this into perspective right from the jump, because we are looking at numbers that, honestly, they force you to refresh your screen just to make sure it's not a glitch.
I know I did.
Right. I mean, this company has seen a staggering 1,000% gain off its early 2025 lows.
It's a truly parabolic chart. And look, if you've been watching this stock go up 1,000%, your natural analytical reflex is probably, heavy skepticism.
Oh, absolutely.
You're probably thinking you completely missed the boat, or that this is just another temporary speculative hype cycle that's just riding the coattails of the broader market.
Which happens all the time.
All the time. So you have to ask the core question. Is this just a massive momentum bubble, or are we witnessing a true structural shift in how compute infrastructure is being valued globally?
That's the million-dollar question. Or, well, in this case, the multi-billion-dollar question. Because when you actually look under the hood at the underlying mechanics, the reality might be even more shocking than the stock chart itself.
Yeah, the price action is only half the story.
Exactly. The core aha metric driving this entire conversation isn't just the share price. It's the top-line revenue. I mean, as of the first quarter of 2026, Nebius Group delivered a massive 684% year-over-year revenue surge.
Which is just unheard of for physical infrastructure. You absolutely do not get 684% top-line growth from narrative hype.
No, you definitely don't.
You don't get it from press releases either. You get it from an absolutely insatiable global demand for artificial intelligence compute infrastructure. And the anchor holding this entire growth story together is that landmark $27 billion deal with Meta.
Which is just a staggering number to even think about.
Right, and this isn't theoretical future revenue projected on some whiteboard. This is tangible validation of their scaling capabilities at the highest possible level.
All right, let's move into the wealth building context because, understanding the fundamental difference between a quick speculative momentum trade and a long-term foundational portfolio asset is critical here.
Totally agree.
Historically, high growth, CapEx-intensive infrastructure plays like, if you think back to the massive telecom fiber optic build-outs in the late 90s.
Oh, yeah, the dot-com boom.
Right, or even the very early cloud computing data centers a decade ago. They required an enormous amount of upfront capital. They just burned through cash to buy the real estate, build the physical buildings, install the complex liquid cooling system.
Stack all the server racks.
Exactly. And as an investor, you always have to remember that true wealth is built on compounding free cash flow over time, not just chasing 1,000% momentum run. If an infrastructure company takes on too much toxic debt to build out or issues too many new shares to raise funds, that dilution eats your long-term wealth alive.
Exactly. And that's exactly why this specific strategic positioning is so fascinating. To really grasp their wealth-building potential, you have to look at the bottleneck they're solving.
Which is?
Well, think of it like an analogy. It's like having the fastest, most advanced race car in the world. Those are the brilliant AI software models everyone is building, but this company is the only one who actually owns the gas station.
Oh, I like that. The digital landlord.
Exactly. Without them, that multi-million-dollar race car is just a very expensive paperweight. They aren't trying to build the smartest AI model, which is a highly competitive winner-take-all software battle where billions can be lost overnight.
Right, they don't care who wins the software race.
Nope. They are simply building and owning the physical real estate, the power, and the compute infrastructure that every single AI company desperately needs just to survive the race.
And by owning that gas station, they are securing multi-year contracts, just like that $27 billion deal with Meta. What that mechanism does is it converts today's frantic, sold-out compute demand into highly predictable, recognized free cash flow for years to come.
Which is the holy grail for investors.
It really is. They are locking in the most well-funded tenants on the planet for the long haul.
Now let's look at the fundamentals, because the execution of that entire strategy relies completely on the math actually working out.
Right. The numbers have to make sense.
We already mentioned the 684% year-over-year revenue explosion. But the metric that truly proves their dominance right now is the profitability scaling right alongside it. Gross margins have hit an incredible 74%.
Wait, stop right there. I have to push back on this because that number defies financial craft.
I know, it sounds crazy.
I mean, you were telling me a company building massive physical structures full of heavy metal, cooling pipes, and industrial generators is hitting 74% margins. That sounds like a typo.
It does, yeah.
Because software as a service companies get 74% margins. Because software is effectively weightless, right? It costs nothing to duplicate a line of code. How on earth is a capital-intensive physical infrastructure business achieving software-like margins?
It is a great question. And it comes down to the mechanics of their pricing power. Because they aren't just renting out empty warehouse space, they are renting out the compute power of advanced GPUs hour by hour at a massive premium.
Okay, but those GPUs depreciate, don't they?
The physical GPUs do depreciate, yes, but because the overarching demand is so far outstripping supply right now, their utilization rate is effectively 100%. They have entirely sold out compute capacity.
Ah, so there's zero idle time.
None. And at the same time, the prevailing hourly rental prices for GPUs across the broader market are just skyrocketing. So their fixed costs to operate the facilities stay relatively stable, but the premium they can charge to desperate tech companies keeps going up.
So they have a scarce resource, and they're just commanding absolute top dollar for it.
Exactly, without sacrificing their own profitability at all.
Okay, well, that mechanism makes sense. That 74% margin creates a massive defensive cushion. But as an analytical investor, I'm always looking at the balance sheet. Building these hyperscale data centers costs billions of dollars up front.
It's not cheap.
Right, which leads to the obvious problem. How does a hyper-growth company fund massive physical expansions without relying on dilutive financing? I mean, usually, a company growing revenue at nearly 700% is aggressively issuing new shares to pay for their expansion.
Which severely dilutes existing shareholders.
Exactly.
And that is usually the fatal flaw for physical growth stocks. But recently, an SEC Schedule 13G filing revealed a massive $2.6 billion passive stake taken by Situational Awareness LP.
Oh, wow, $2.6 billion.
Yeah. Now, for those following along, when you see a 13G filing, that is Wall Street's version of a massive, I believe in you check. A 13G strictly indicates a passive supportive position, unlike, a hostile takeover attempt.
Right, they're just parking their capital there because they believe in the execution.
Yeah. Exactly. And that sheer level of institutional capital injection heavily de-risks the capital structure. It means they have the raw liquidity to build out their infrastructure without punishing their current investors with share dilution.
And I imagine that institutional money is flowing in because the competitive moat is so fiercely defended. We aren't talking about selling server space to mid-tier startups here.
No, not at all.
We are talking about operational validation from giants like Microsoft, Meta, and NVIDIA. Once those hyperscalers actually integrate their complex workloads into this infrastructure, the switching costs become astronomically high.
Oh, it's a nightmare to switch.
Exactly. It's too painful and expensive for Meta to suddenly unplug everything and move to a competitor. It creates a massive barrier to entry. But we have to talk about the absolute biggest physical bottleneck for AI data centers right now, because it isn't actually getting the computer chips.
It's getting the power.
Exactly. You can have all the advanced GPUs in the world, but if you can't plug them in, they are useless. And municipal grid connections can sit in a regulatory queue for 3 to 5 years.
And this is where the story gets really compelling from an engineering standpoint. They formed a strategic deal with Bloom Energy to provide on-site power solutions.
Wait, so they aren't even relying on the city grids?
No. Instead of waiting half a decade for a city to approve a new power substation, they are using Bloom's solid oxide fuel cells right on the property. These fuel cells generate electricity on-site through an electrochemical process without combustion.
So they're essentially building their own microgrids.
Exactly. What that means in plain English is they bypass the municipal grid queue entirely. They elegantly solved the single biggest physical constraint plaguing every single one of their competitors. They can build and power up facilities years faster than the industry average.
That's incredible. It's a race, and they just secured their own private fuel supply. That brings us to the catalyst timeline. Because, the fundamentals tell us exactly where the company is today, but catalysts tell us what actually moves the stock price tomorrow.
Absolutely.
Looking out over the next 3 to 6 months, we have significant macroeconomic tailwinds. We are seeing a broader sector rotation into AI infrastructure equities. But more importantly, let's look at the mechanics of interest rates.
The macro environment is shifting, yeah.
Right. As interest rates stabilize, or if we see further cuts from central banks, the discounted cash flows of a capex-heavy infrastructure play become highly attractive. When you build a multi-billion-dollar data center, you are financing that cost.
And debt isn't cheap right now.
No, it's not. But when interest rates drop, the cost of servicing that debt drops, which instantly increases the present value of all those multi-year, multi-billion-dollar contracts they are signing.
The macro picture is a huge tailwind, but the micro catalysts are stacked right in front of us too. The most imminent is the upcoming Q2 2026 earnings report.
Well, that's going to be a big one.
It's going to be incredibly critical because the broader market needs to actually confirm the run rate of that $27 billion meta deal. We need to see exactly how that massive headline-grabbing contract is translating into actual quarterly recognized revenue.
Right, and if they can maintain or even expand that 74% gross margin as they scale.
Exactly. Additionally, with the sheer frantic pace of this industry, upcoming investor days, or AI infrastructure conferences, act as major catalyst beds. That's exactly where you might see surprise announcements of new hyperscaler partnerships that mirror the Meta blueprint.
So you're looking for the next domino to fall.
Yeah. If they step on stage and announce another $10 or $20 billion contract with a Microsoft or an Amazon, the market is going to reprice the stock instantly.
Well, the market is certainly trying to price in a lot of perfection already. Now let's pivot to the chart. Technically speaking, the stock is in what you can only call a massive secular uptrend, maintaining that 1,000% gain from the early 2025 lows.
It's beautiful to look at.
It really is. But let's zoom in on the recent price action, because a very specific technical trading signal flashed recently at the $223.62 level. When the stock hit that trigger, it initiated a decisive 4.2% surge to an intraday high.
That's a strong rejection of lower prices.
Exactly. What that tells us from a structural psychological standpoint is that the market was testing a prior consolidation zone. Instead of rejecting that price and selling off, buyers stepped in heavily. That $223.62 level is now acting as a new psychological and technical support floor.
And that price action perfectly reflects the momentum and the underlying flow of funds we are seeing under the surface. When you analyze the daily chart candles, you see high conviction gap ups, particularly following that 13G filing from Situational Awareness LP.
Just to clarify the mechanics here for everyone, a gap up means the stock opened significantly higher than it closed the previous day, right?
Yes, exactly. That shows an intense urgency from institutional buyers to get in before the retail market even opens. What this communicates is that the market is fiercely buying dips.
They aren't waiting for a perfect entry.
No. Anytime the price softens even a little bit, deep-pocketed institutional money is stepping in, easily absorbing any overhead supply from early-stage investors who might be, looking to take some profits off the table. The momentum regime here is incredibly strong.
Which makes total sense when you look at how Wall Street is actually talking about them. So what does market sentiment look like?
It's overwhelmingly positive.
Right. If you look at the quantitative scoring of recent financial headlines, it is a clean sweep. 5 out of the 5 top stories right now are distinctly bullish. We're talking about headlines highlighting ballooning upside potential, the smartest AI money buying in, and those powerful pricing tailwinds we discussed earlier.
And that overarching bullish mood is formally backed up by analyst actions. We are seeing a steady wave of buy and strong buy ratings rolling in, driven largely by the fact that their capacity is entirely sold out and they can dictate terms to their
The
clients.
pricing power is undeniable.
It is. But the most important sentiment indicator isn't just coming from analysts writing reports at their desks. It's coming from sophisticated, smart money participants voting with massive amounts of capital. Leopold Aschenbrenner recently disclosed a 5.6% active stake in the company.
No, wait, an active stake is very different from the passive one we talked about earlier.
Extremely different. We talked about a passive stake earlier, but an active stake means this highly respected, deeply connected institutional investor intends to have a voice in the company's direction.
They want a seat at the table.
Exactly. When a player of that magnitude takes an active position of that size, it serves as a massive, glaring vote of confidence to the broader market. It validates the entire thesis that this is a top-tier generational infrastructure play.
It absolutely does, but I have to push back on some of the noise surrounding this sentiment, specifically regarding the speculative market chatter.
The rumor mill is definitely churning.
Oh, it is. Because of this massive 684% growth, there are wild rumors floating around retail trading circles and some financial blogs that this company is becoming a strategic acquisition target.
You're right, the buyout rumors.
Exactly. That a larger hyperscaler, like Google or Amazon, might just step in and buy them outright to instantly augment their own compute footprint. I want to strictly remind you, the listener, that absolutely no confirmed M&A reports exist yet.
None. It's just noise right now.
Pure noise. Making an investment decision based on buyout whispers is an incredibly dangerous game, especially after a stock has already run 1,000%.
Yeah.
You have to evaluate the company entirely on its standalone merits.
I couldn't agree more. You simply cannot build a resilient investment thesis on whispers. You have to build it on the verified 684% revenue growth, the actual legally binding contracts, and the hard math of their margins.
Exactly. And that leads us to the reality check.
Yeah.
Now let's talk about the risks. Because in financial media right now, there is a fascinating article discussing the risk nobody's talking about.
Always the most important thing to look at.
It is. And as an analytical investor, that's exactly where my attention immediately goes. The primary risk here is severe supply chain and operational execution risk. Think about the pure physics of what it takes to scale physical infrastructure at a 684% growth velocity.
The logistics alone are mind-bending.
They are. You are globally sourcing thousands of incredibly scarce GPUs, miles of specialized fiber optics, and highly advanced liquid cooling systems. If a single supplier delays a shipment, or if there's a localized labor shortage for the specialized technicians needed to weld the cooling pipes, your entire multi-billion-dollar expansion timeline slips.
A chain is only as strong as its weakest link.
Exactly. Imagine having a billion-dollar facility sitting completely idle because you're waiting on a $2 specialized valve.
Those are very real, tangible execution risks. You simply cannot scale that fast in the physical world without massive friction. And furthermore, there is absolute valuation and profit-taking froth in this broader sector.
We've seen it happen recently.
Yeah, we recently saw violent profit-taking in peer companies like Bloom Energy after they had their own massive run-ups. When a stock is up 1,000%, expectations are priced at absolute perfection.
There's no room for error.
Zero. Even a microscopic miss on an earnings estimate can trigger a brutal, violent sell-off as everyone rushes for the exit door at the exact same time.
But we also have to look at the objective mitigation for those risks. Yes, the valuation is frothy after a 1,000% run, but unlike the speculative hype of the 2021 tech bubble, where companies had zero revenue and were valued on clicks.
Right, the vaporware era?
Exactly.
Yeah.
This valuation is increasingly supported by real, fundamental cash flows. They have those 74% gross margins. They have that legally binding $27 billion meta contract. That puts a very real fundamental floor under the narrative.
It's not just a story, they have the numbers.
They do. And regarding the operational execution risks, as we discussed, they entirely mitigated their largest operational blind spot by securing that strategic deal for on-site power generation. They are insulated from the municipal grid bottlenecks that are currently paralyzing their peers.
So with everything on the table, what's the final verdict?
It's a lot to weigh.
It is. When you synthesize all of this data, the staggering revenue growth, the massive institutional backing, and the inherent friction of scaling physical assets globally, you are left with a highly attractive but inherently volatile setup.
You have to be ready for a bumpy ride.
Because of that historic 1,000% run-up, Investors absolutely must have a strong stomach for momentum fluctuations. It's a high reward play, but it will require navigating some violent intraday price swings as the broader market constantly reprices their execution in real time.
But before we get to the final score, it really forces you to think about the bigger picture here. I mean, if Nebius is effectively locking up all the available physical power and compute capacity through these multi-year mega contracts with giants like Meta,
What happens to everyone else?
exactly, what happens to the AI startups of tomorrow? Are we heading toward a future where human innovation is gated entirely by who owns the electricity and the cooling pipes? It's a fascinating, slightly terrifying thought to explore on your own.
That is the ultimate macro question of the next decade. But bringing it back to the core strength of this specific business today, our final investment rating yields a bullish score of 9 out of 10. The target horizon here is firmly defined as a multi-year hold.
Right, you're not trading this for next week.
Now, the true realized value of this company isn't about what the stock ticker does next Tuesday. It's about what happens as their entirely sold-out compute capacity comes online over the next several years, methodically converting that insatiable global AI demand into undeniable, compounding free cash flow.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this deep dive helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.